Hey everyone, this is Arjun Badola, and you're listening to the School of Worldly Wisdom, where I share my insights on investing, self improvement, and startups. For more info, visit arjunbadola.com. So, today we will be talking about some of the basics of investing. We'll be answering some questions like why one must invest, what is the difference between trading and investing, how to get started with, what to avoid, should you do index investing or should you go for stock picking. So I will try to address some of these basic questions today. So let's get started. So the very basic question, why one must invest? The first reason I would give is to experience the magic of compounding. And the magic of compounding is the compound interest, which you get only when you invest for long term, and you can invest for long term only when you start early. Now, I feel starting early gives you two advantages. First is that you can fail early, and second, that even if you fail, the loss is not huge. So, I had also written an article on it, and I would like to share my personal experience which I had written in that article. So, in that article, I had mentioned three things which I learned after failing early. So, the first one was I used to invest in companies which were outside my circle of competence. I realized this after reading about Warren Buffett in depth. Earlier, I just used to blindly follow, watching some old videos of Warren Buffett, and I never realized that Warren Buffett had changed his philosophy. Earlier, unknowingly, I used to follow Benjamin Graham's style of investing, where you look at, it's also known as cigar butt approach, where you look at some stocks which are available at very cheap valuation, then you buy a basket of those, and you hope that if you're buying example 30 stocks, then there's high probability that at least few of them will take cover of the losses of the others. So I think that philosophy does work. It worked for me, but I was I was following that approach based on the presumption that Warren Buffett follows it. But I was wrong. I realized it later. But luckily that was not a big mistake for me. Yeah. So okay. So that was the cigar butt approach. But what I was talking about is outside investing outside your circle of competence. A circle of competence means things which you can understand. So for example, a normal consumer could understand the products which he use. So for example, I could understand what I could understand the economics of, let's say, Maggie. So for example, if I have a bike, I can understand why people prefer Royal Enfield over the others. Or if I drink tea, I can say why Tata tea. Or if you are into cigarettes, then you would say, okay, why do I buy Gold Flake or why do I buy Marlboro? So these company would most probably would be falling under your circle of competence. So circle of competence in short means things which you understand and where you would get some edge over others. So in these products you would definitely get some edge as you might have been using these products for a very long time. So yeah, so that was my first mistake. I had invested in companies which I never understood, but luckily the market timing was fine and I made some money there. Now the second mistake which I did was I did not use proper valuation methods. I just went by the cigar butt approach. That is, if it is closer to the book value, you just buy the shares, and you expect them to work within 3 years. If they don't work, you sell them out. But this is not a proper valuation method. A proper one, I would say, where you are calculating the future prospects of the business, or you could say where you are looking at the cash flows. So one would be DCF valuation method. That would be a really I would say a proper valuation. Even DCF has its flaws, but I would say it is a proper valuation method and not just based on what price to book value the company is selling at. But I personally use the valuation method of Professor Sanjay Bakshi. I think it's named as expected returns model. where we focus on the earnings of the company and not just on the cash flows. So yeah, that time this was my second mistake, that I did not follow any valuation method and just went by the PB, that is price to book value of the company. The third mistake I did was not studying about the competition. So this mistake is quite recent one, where I had invested in VIP Industries, and I still think VIP Industries is a good stock. But the problem is, I personally am not able to figure out how it's going to stand up against Samsonite, because Samsonite has its some other set of problems, but but yes, but I'm not able to clearly understand if both the players stand together in the market, who is going to win. So studying the competition is very important. So sometimes what happens that you just look at the Indian companies and you say, okay, this is the best company in India, so let's invest in it. But you never realize that there is a competitor outside India who is doing very well. That is the case which happened with VIP Industries for me personally. I know I might be wrong somewhere, but I can't build up the conviction, because I fear that Samsonite could be a better player out there who has a better distribution system than VIP Industries. But if the sector is growing, then I think each player will grow, and as there is a organized and unorganized, as there is a shift from unorganized to organized players, I think all the companies in that sector could gain. So I think studying the competition is very important, because you don't want that an international player who was just restricting themselves to enter India, one fine day decides that, okay, let's enter the market, and takes away your market share. So I think those were the three mistakes which I faced in stock market. Now, yeah, so we were on the topic that why one must invest, and to conclude that, I would say that compound interest is the main thing, or the main reason one should invest, because compound interest gives you interest on interest, and that is one of the ways through which you can achieve wealth for yourself. The second point which I would like to say is that for financial freedom, so one must invest for their financial freedom. So if you're a college student like me, then I would highly recommend reading books and learning investing, so that maybe after 20 or 30 years you have enough money that you don't have to work for someone else. And this 20 to 30 years which I'm saying is for if you get very average returns, but maybe investing is for you and you get quite good of results maybe within 10 years or maybe within 5 years also. So investing could make you financially free, and then you could decide what you want to do, whether you want to work in the current job or not. So investing gives you freedom financially. So moving forward to the second question, that is trading versus investing. So just now we talked that one must be in the market for the long term, and that's how you're going to get the benefit of compound interest. But there's another way to make money, and that is trading. So I personally don't trade, because I believe I cannot understand what trading is and how one could excel in that. But that doesn't mean that this thing doesn't work. There are a lot of people out there who are doing quite well in trading and actually making more money than people who are investing passively and sitting out there. So trading could be a really good thing if you could understand what this means. But trading so if investing would require 10x of your emotions, trading would require 15 or 20x. Trading is all about your emotions. Even investing is. But in investing, you also need to learn about the fundamentals. Whereas in trading, it's more about the price movement. In trading, you need to think about how the public will react to a particular news, and you have to you have to react before them. I believe competition is huge in trading, as there are so many types of trading now. Now people have also come up with high frequency trading, where they set up their office near the stock exchange and try to trade in milliseconds. So to place order before them is going to be a huge competition. Then we have taxes. In trading, you will be So in trading, what you're doing, you're buying shares and selling within the 1 year. That means you have to pay taxes on the gains which you made. Whereas in the long term investing, you buy once, you hold it, and you sell after 10 years, or maybe after 5 or 10 years, and you pay tax only once. That is at the end of the 10th year. So I would say that you must first try trading. Generally, people advise that don't try trading, get away from it. But I personally think you must try in trading, see whether this thing works for you, and just don't try and leave it and think that okay, it's not working. Learn about it, read books on it, see how it works, try to read chart patterns, approach someone who is into trading, and learn how they do it and what are the pros and cons. But I've covered some basic pros and cons for you in this podcast, but I would highly recommend you also learn trading. And after a month, after some experience, like maybe 2-3 months, when you think that okay, now I got the basics, then you can decide whether it's working for you or not. I personally feel it does not work for me, hence I'm a long-term investor. Now moving to investing. In investing, you could avoid the competition. Like you could avoid the 90% of the competition by just selecting the style of investing you want to follow. For example, if you are in the game for long term, you have already defeated almost 90% of the competition, because it's very difficult to stay in the game for long term. I had also written an article where I talk about the edge retail investors have. So retail investors are people like you and me. They don't have much resources to research on companies. They don't have a team of research analysts, and they try to investigate about a company through the means available to the whole public, and their capital is also not huge. When you're applying for an IPO, a retail investor might be who has a capital of less than rupees 2 lakh. But in the broader sense, even if you have, let's say, 5 lakh rupees of portfolio, even then you could call yourself a retail investor, because generally people communicate retail investors as someone who does not have the resources like a mutual fund or a brokerage firm who has so many people working for them, whereas a retail investor works alone and does not have resources to conduct much deeper analysis. Like they could conduct a deep analysis, but they don't have the so-called professional methods to do the analysis. Now in my article, I had shared 4 points where I said that these are the 4 edge which a retail investor has. So the first one, which I said, that being in for the long term. So that is, if you, like I said, that if you decide to be a long-term investor, you have already defeated 90% of the competition out there, because people are not here for making wealth, they're here for making money. I would say if you want to make money, then you should try trading and not investing. Then second point which I mentioned was discipline and patience. So what a retail investor can do is that he is standing alone there, and the only emotions which you have to control is yours. Whereas if you're in a mutual fund, you have to deal with your boss or your colleagues who are constantly saying that, oh, sell this stock, buy that stock. And there is also pressure when if everybody is buying out a stock, or let's say buying out from a sector, then even you have to participate, because your clients or your colleagues or your boss would be standing there and shouting on you, what are you doing, why are you not buying? It's very difficult to maintain your discipline and patience when you're working in a mutual fund. Whereas as a retail investors, you can do whatever you want. You have the freedom to deal with it. You can invest whichever sector you want. You can wait for 5 years, even if the 5 years the stock does not perform, but you still know that the company is performing, and sooner or later the stock will also perform. Then you can stay invested. There's no need to sell, because even if the 5 years returns are 0 or even negative, but on the 6th year the stock went 10 times, then the pain which you went through is covered by that 10 times gain. And the last point which I would like to mention is that the micro and small cap investing, which generally mutual funds or these brokerage firms can't do, because there's some technicality in that. There should be enough shares in the market so that a mutual fund who has a lot of money could buy that stock and sell when the price is falling. Because when the price is falling, the number of it's all about demand and supply. So when the price is falling, nobody is ready to buy the stock, and a mutual fund has huge money, so whenever they buy in huge quantity. So to offload those quantity, they need a huge demand out there so that they can offload the share. Whereas if you take a large cap company, or let's say if you take ITC, and ITC is a huge company. I think the market cap of ITC is around 2 lakh crore. So 2 lakh crore of market share, then I think it would be very the it could be very easy for a mutual fund to offload shares if they think that the price would start falling. So those were the some points which I had mentioned in my article, where I had talked about the edge which retail investors have. So that was that. So that's about it for investing versus trading topic. Now let's get into the practical approach. So if someone wants to start investing today in India, what should they do? So I think you need two documents for that. One is your PAN card and the second one is your Aadhaar card. And you can I would recommend going for a discount brokerage and not a traditional one. So a discount brokerage is one where you get the platform and you go and place the order on the website, and that's it. The shares are yours. Whereas in a traditional one, you have to call a broker, or you can go to the platform, but there's always a broker available who would call you and advise you, sir ye le lo, sir wo le lo. But I would recommend not going for that, because having a broker out there can heavily influence your decision. Because there could be times that you call him and you say ki, sir, please buy this. He would recommend, don't buy this, there is another better opportunity available, and maybe he's good in sales and he would convince you to not buy that and buy instead something where even he's earning a lot of profit due to that trade. So I would highly recommend going for a discount brokerage, and the discount brokerage which I would recommend is Zerodha. This is not a sponsored call. I personally use Zerodha, that's why I'm recommending. Otherwise, one could also go for, I think, Upstock. I have heard that Upstock is also good, but I personally use Zerodha. So yeah, so you need a PAN card and an Aadhaar card, and I think the process is pretty simple. Then I think you can go to the website, but and follow the steps. But the only two documents is Aadhaar and your PAN card. So before you get into investing, one must know that what they should avoid. And I would say that survival is the key in investing, because even if you get a 10 bagger and you lose it in the next stock, then there's no use. So the safety of the capital is very much important. Even Warren Buffett defines risk as loss of permanent capital. So one must remember that they should never lose their capital. As Warren Buffett says, he defines investing in two rules. First one, never lose money, and rule number 2, never forget rule number 1. So surviving is the most important thing in investing. I would highly recommend to focus on protection of capital first and then think about the returns. That is how you're going to stay in the game for the long term and not get distracted by short-term results. So okay, now let's suppose you have decided to open the account, you have got the account, but now one must think that should they go for index investing or should they go for stock picking? Now what are these? So index investing means that you invest in the index itself. The index is the market. It consists, so if there are two famous index in India, one is Nifty 50 and one is BSE Sensex. So Sensex consists of 30 stocks, some 30 good companies, and Nifty 50, as the name suggests, has 50 stocks in it. So the financial performance of the country is measured by these two majorly known index. So index investing is that you buy a fund which will invest your money in these two, one of these fund, that is Nifty or Sensex, in the same proportion how the Nifty or the Sensex is designed. So for example, if Nifty has given 10% weightage to Reliance Industries, then your money will also be divided into that proportion. So 10% of your money will be in Reliance Industries and rest will be divided in the same weightage as the index has. So why one should go for index investing? It is that if you have, let's say you have no interest in learning, why should I learn stock market, but you still want the magic of compounding, then index investing is for you. You require no time and no special knowledge about anything. You just open a demat account and you select a fund which provides you with the lowest cost. Remember there, going for a low cost fund is the key here, because if your returns compound, your cost can also compound. So one must always go for a low cost. I would recommend going for a Nifty 500 index, that is Motilal Oswal had started, because it's a much bigger index and it consists of 500 stocks. So I think it would be better betting on 500 instead of 50 if you're going for the index. And I especially want school children or college students like me to invest, because we have a huge advantage, that is, we can start early. I would say that we could invest some money which we had thought, which we would have anyway wasted somewhere else. And trust me, you would be really surprised when you see that how it has compounded in next 10 to 15 years. I would share one tip from the book which I read, Richest Man in Babylon, where they had recommended that whenever you get your income, first save and then spend. So for example, if you're getting your monthly salary or your monthly pocket money, first remove 10% from it and invest it immediately. Go for an SIP or just invest immediately, and then think that 90% is your income, and now you're going to decide what you have to do with that 90%. So I would highly recommend that you should start investing as early as possible so that you can get the edge over there. Now coming to stock picking, I would say stock picking requires a lot of passion there, because you need to put in the effort. You need to read about companies, how they are performing, which business models work, how is the management of the company, is it available at fair valuation, what is the future perspectives of this company, do they have any competitive mode there. So it requires a lot of time figuring it out, and if you're doing some job, then it would be really difficult for you to do stock picking. But there are people out there who are doing, so I'm not saying that it can't be done, but it would need passion to do it. Second thing is that even after putting the effort or doing a lot of hard work, there's no guarantee that the returns will be great, because there could be times that when you could go wrong. Whereas in index investing, we know that in the long term the index is always going to be up, because India will do good, and therefore the stock market will do good. But remember, in the long term. But if in stock picking you are right, the return can be significantly higher. Let me share you with some examples. So there's a company known as PI Industries, and if you would have invested rupees 10,000 on July 3rd, 2000, then today you would have 171 crore rupees. That is around 1,71,000% return in the period of 20 years. Then you have a famous company, Symphony. You might have used cooler of Symphony. The same amount would have been around 140 crores. Then you could say Eicher Motors. You might have definitely seen Royal Enfield on the roads. So Eicher Motors is the company which make Royal Enfield. So if you would have invested rupees 10,000 on July 3rd, 2000, you would have got 60 crores rupees today. So these are some unique examples, but I'm just giving this example as to show that it is possible. So if you're right, stock picking could change your life and you never have to work again. But if you're wrong, then it could also affect you in a bad way. So one must decide the risk appetite they have, how much they can handle, and are they willing to put in the effort. So if you have the passion and you're willing to put in the effort, I would highly recommend going for stock picking. But if you think you just want the magic of compounding and you're not interested in doing the hard work, if you don't want to analyze a company and don't want to get into technicalities, then index investing is for you. So that's about it. That is that is what I wanted to talk about index investing and stock picking. So I hope today's podcast has taught you something about investing and how one should go about it. In the coming podcast, I would try to cover how one must invest, what are the parameters one should look at, and I would also try to share my investing process, how I do it, and what are the things I look at. So thank you for tuning in. We'll see you in the next podcast. Thank you.